Hello, everybody, from our home office to your home office. I'm here today with Russell Kett from HVS International and with Michael Grove from HotStats. And we will actually discuss the latest presentation of Michael Grove on Profit Matters. My name is Bettina Graef-Parker. I work for Ariel Bank, and obviously for a banker, profit does matter. So let us jump right into it. In Michael's presentation, we discussed, or Michael discussed a lot about hotels being open or being closed. My perception of the latest crisis is that in the first lockdown in March, the decision to close a hotel came very quickly as hoteliers were dealing with issues they had never faced before. Now, in the second wave, where we face more of a lockdown light, hotels are actually closing down less. And I think, Michael, you have actually shown a slide in your presentation. It was slide number 18, where you show that hotels, despite of having low occupancies, once they're open, can still manage to generate a profit or even reduce their loss whilst closing down. Is this something that you have perceived in all asset classes?
Yeah, I mean, the profit and loss makeup of hotels has changed and continues to change. So the break-even point in which they can drive that, and whether that is looking at occupancy level break-even point or a TrevPAR break-even point, there are multiple dynamics to that. So it's difficult at this stage to say for sure that, you know, at the set break-even point, the last 3 months, as I indicated, for luxury hotels, 32%. Across Europe, we were around about 27% across assets. But that is, you know, is still very temporary. It was still very much, the situation is very much evolving. The cost base has been dramatically hit by many different angles, whether that is shredding of costs, fixed costs out of the business temporarily or permanently. And of course, the assistance from government support in certain regions. So it's not necessarily that you know, post-crisis or the post-lockdown, this would be something that would continue forever, because it's very much linked to the fact that hotels, in many circumstances, being forced to close or only open for essential travel.
And Russell, do you see this in the hotels you appraise and consult on? Do you actually make a change in or a difference in your assessment of value, whether a hotel is currently closed or not?
Well, clearly from a valuation perspective, we're looking at the earnings of that hotel starting on the day of value and looking forward from that point. So if a hotel is currently closed and you're valuing as at today, then you have to take that into account. You also then have to take into account what the operating profile is likely to evolve into, how long it's going to remain closed, when it reopens, what the situation will be once it reopens, how much business it will get in the initial weeks and months, and eventually over the ensuing several years. So you have to take that view based on the circumstances that you find at the time. But what I've discovered is that hoteliers and hotel operators have become incredibly nimble. They've looked at the situation that was thrust upon them way back in March, and they've recognized that they need to be quick and light-footed, and they need to reflect change in their business as quickly as they can, so that, as Michael has said, profitability can still be maintained even at quite low occupancies.
And in your perception of the hotels that you monitor, Michael, is it also correct that hotels that open and remain open, even if business is low, have a much better and quicker start when business opens up again? Is that something that you have perceived in the summer months?
No, well, I think it's quite difficult to assess because the situation is very different in each region. I mean, when I'm looking at occupancies, the danger, of course, of looking from an occupancy point of view is you don't really take into account the the TrevPOR, the available the rate for the average rate across the property. And of course, that is right now with many of the parts of the buildings closed. Even open hotels are not totally open, so they haven't got to the point where we've managed to optimize all areas of the business. What is useful, I think, what's been incredibly kind of successful in this circumstance is the way that we've been able to react to the cost base and start the thoughts of reevaluating the use of different parts of the hotel. I think that's really been something to consider. And we are now running at a better profit margin in the more advanced countries such as China, where they're a couple of months ahead of us at a lower average rate and at a lower TrevPAR, but are driving GOP to the levels of last year. I think that is something to really consider in as we come out the other side of this. But from a starting point, I think it's the fact that everybody is reevaluating the performance of the assets right the way down to to white paper review, and I think that is being that will put us in better stead coming out the other side of this.
Thank you. You've mentioned the word costs. Now, I work for a bank where we finance real estate and we finance a lot of other assets than hotels. And hotels have always sort of been the black sheep with having very high fixed costs and being the most volatile in crises. Russell, you're nodding, I see. What is it that we have learned in this crisis about the costs of hotels?
Well, some of us learned this lesson quite a long time ago, but we've not been very good at spreading the word and getting the message out. If I can just reflect back on my own personal history, my operational life goes back 45 years. And when I first came into the business, we managed everything by something called occupancy. If we were full, then we were doing well. If we weren't so full, then we weren't doing that well. Then all of a sudden, we learned the lesson about average room rate. And of course, any old fool can sell a room at a very low room rate. So it became more important to get not only a good occupancy, but a good average room rate as well. And then we put that together and we came up with something called RevPAR, rooms revenue per available room. And that for many years has been a very good benchmark that people have used when comparing the performance of hotels. Michael has referred at least twice already in this discussion to TrevPAR, total revenue per available room. Again, very helpful, particularly when you're looking at the contribution of restaurants, bars, meeting space, and other facilities within a hotel to the total revenue. And of course, GOP per available room, gross operating profit per available room, increasingly far more important than ever before, because you can't take revenue to the bank, but you can start to think about taking profit to the bank. But there's another measure that I want, and I think others increasingly want to see, which is earnings per square meter or per square foot, in that it enables those who are either investing in real estate or financing real estate or even operating real estate. And in this case, hotel is real estate. And those people who can produce their financial data, not only in statistics that are per occupied room or per available room, but per square meter, will benefit immensely in the future from how their hotel is performing.
And Michael, is this something that you will start being able to report at HotStats soon, or that you're collecting data on revenue or costs per square foot or square meter?
Yeah, I mean, the challenge really for us, me and Russell have had this discussion before as well, actually. I think it's certainly a very important point, and it's something that, I personally also really believe in. I think that it really helps in many different ways, because per available room doesn't necessarily, it's not just for being able to go cross industry, but it's also the fact that, some areas of the building, it just doesn't make sense to compare them against the amount of available rooms it has. Some hotels are very much built on the conference and events area, for instance, and have a small amount of bedroom space. So it doesn't necessarily make sense to look at hotels that way. Per square meter would certainly be the ultimate. We actually provide square meter analysis for conference and banqueting in particular, because that's low-hanging fruit for us. We're able to collect that either from the operators directly, or even it's often advertised on websites. But the issue, of course, is being able to collect the actual, whether you're looking at the gross internal area of a hotel or the net internal area. We need to decide what that is and have a kind of industry standard. It probably should be supported by the Uniform System of Accounts as the reference point for hotels, and therefore almost mandated, so that it's something that can be benchmarked and useful for owners and investors around the world, of course. Now, from our point of view, we have started the process to collect that. Many operators, I'm aware, either don't keep that data, or it's difficult to access it. And of course, we needed to define the definition, which we've started the process of now. So in long and short, we'd like to do it. We're very much keen to do it, but it's something that I don't see happening very quickly. That's for sure.
Well, one thing that is going to help is for hoteliers to recognize that they are operating a piece of real estate, and the investors in that real estate potentially are not just looking at investing in hotels. So when they're looking at a hotel investment and comparing it with general office development that they're looking at, or retail or residential development, everything comes back to earnings per square meter. And the sooner we can recognize that, the sooner we may well then be attractive to general investors, not just those specialists who have learned to love the hotel industry as we have.
Yeah, exactly. I think that the fact is, Russell, I mean, we've been, as an industry, I think we've, as you alluded to, we've been pretty much obsessed with rooms revenue, and that's why we're very good at driving rooms revenue as an industry. The other parts of the P&L are becoming something that we measure more of. Of course, we're the key providers from the other parts of the P&L, but really to get general managers and the industry thinking like asset managers, thinking like investors. I think this environment, the current crisis, has really kind of pushed that. It's driven that forward, because you need to make best use of the building as you are. It's not useful to have room service, for instance, as a sideline revenue, because at the moment it's a great opportunity for guests staying in the hotel to stay COVID secure, and to be able to, you could still deliver the same amount of revenue to the room service as you would in the restaurant, for instance. But you need to understand that some parts of the building will not return anytime soon, and you will need to try and maximize the use of the space from around the building. And per square meter, I think, makes a lot of sense in doing that.
From our perspective at the bank, we're obviously looking at these profits that have now tumbled below zero, I would say. And the big question is always, when will we go back to 2019 levels? And some people forecast demand coming back to 2019 levels, and then they say, obviously profit's going to lag behind. Other people are saying, well, profit is actually going to return faster, because we have now been able to shed costs from our P&L that we will not be picking up anymore, because in 2019 we were really at the height of the industry, and we sort of splurged out on the luxury of having certain positions in hotels that we will not be recruiting again, and that we realize we actually truthfully don't need. Michael, in your presentation on page 16, you have shown how expenses have decreased, admin in general by 42.5%, sales and marketing by even close to 60%. Do you have a perspective of how much of that is going to come back, and how much you have seen come back in the summer months, for example, when business picked up? And do you also, in your analysis, have the perception that some of these costs may not actually come back?
Well, as I think I alluded to, and without wanting to repeat what I said in the presentation, to go back to your point on the undistributed costs in particular, which were predominantly fixed prior to the crisis. Right now, what has happened is that that full zero-based budgeting that most hoteliers, I believe, are looking at a kind of 3 months ahead rather than the next 12 months, because you really need to prepare yourself for the short term as well as the long term right now in a much different way. that has meant really scrutinizing every part of the P&L. So there are definitely going to be many circumstances where costs have been cut, and possibly from a permanent point of view, and in many ways possibly necessary. You allude to the kind of the way that we have done things historically, the way we were doing things in 2019. Also needed revisiting. It needed looking at. We are moving much towards a digital world, a digital environment. There are many parts of the cost structure in hotels that didn't react to that. We will need to spend more in terms of IT, digital marketing, these areas that I think the hotel industry in some ways has lagged behind a bit. But there is also the fact that many of the costs are temporarily parked. Within the undistributed costs in particular, you've got the marketing fees that are very much linked to revenues for the branded hotels. That is an area that will no doubt return as the revenue ramps up. You have the operating expenses. As I said, you need a good sample of data to be able to understand how that is evolving. 1 month you look at it and it's 30% up. 6 months we're looking at it and we're back to the prior year levels. In fact, a little bit less than the prior year. So those things are evolving. I think it's quite dangerous to take a view of that immediately. What I can tell you from looking at the China performance, and again alluding to that, just because I think that that's a region that there's a bit further ahead in the crisis than us, is the fact that as GOP part has you've seen a 2% improvement in margin and a 2.5% change in labour costs, a lower ADR and a lower TrevPOR. That does indicate that as hotels are opening back up, they are much leaner than they were when they entered the crisis.
Bettina, every general manager I speak to, every hotel owner that I speak to, every operator that I speak to is proud to boast that they have reduced operating costs. And the reason they're proud to boast is because it has been forced upon them by circumstances. And they have not had any sympathy from too many people to want to keep their operating costs at anything like their previous levels. I was speaking to a general manager this morning of a luxury hotel, and he was telling me that at 28% occupancy, they were still making a positive gross operating profit. Okay, probably not enough to cover their debt and their interest, but they were making a positive GOP, even at 28% occupancy. Now, that is because they've been managing their costs particularly well. And one of the reasons they're managing their costs is that people like him have been serving breakfast. It isn't a question of just letting everybody else get on with it. It's people mucking in and really recognizing that for that hotel to be successful, everybody needs to pull their weight. Just because you had a role before, then that role may need to be adapted into the future in order to keep the cost base down.
That now I have a very interesting question for myself. I used to work for HVS as well, as you know, and I know how you base your models on the fixed and the variable component and cost. So my question now is, have you made permanent and have you instructed the people you work with to make permanent adjustments to your assumptions going forward?
Interestingly enough, we are able to project forward on the basis of improved margins because of the evidence that we've already had in the last 6 months. We've continued to value hotels into the future. As for the last 6 months, we can't just sort of say, no, terribly sorry, we can't value this hotel. We need more evidence. We need hotels transacting to give us market evidence and whatever. No, people don't wait for that. So we've been looking very carefully at those operating performances and taking a view as to how much of this can be continued into the future. But that requires cooperation on everybody's part. It needs the brands to accept that their brand standards, whilst they've been flexible in adjusting them in the short term, some of those changes need to be reflected in the longer term. So the idea of what was a fixed cost, yes, was a fixed cost, is a fixed cost, but doesn't necessarily have to be at the same level as it was in the past. And that's the critical aspect.
Okay. And you also mentioned something about break-even occupancy, basically. Michael, you spoke about it. Russell, you now said that the GM of a luxury hotel said that he could break even basically below 30%. This is something that I think, before this crisis, nobody would have imagined this. For example, also where we as Ariel Bank, we finance predominantly full service hotels in the upper upscale segment and luxury hotels. And throughout the crisis, we have been targeted people saying, "Oh, are your hotels going to suffer much more than other hotels? Do you have hotels that have higher fixed costs than other hotels?" And or they haven't even asked, they have assumed that we would finance hotels with higher fixed costs and with higher break-even. But Michael, your analysis has shown that luxury hotels actually have a lower or a similar break-even occupancy as other hotel types. Can you explain what you believe the reasoning to this is?
Yeah, I mean, Russell's the example there of the 28% is actually in line, in fact, a little bit higher in some regions than what we were seeing prior to the crisis. But you need to put in the context of the fact that the revenue at that occupancy level, what the TRevPAR looks like, because in the current circumstance, you may be selling more bedrooms at a much lower rate. And of course, across the board, the loss of the ancillary revenues linked to those bedroom stays doesn't drive that TRevPAR as it is for the property. And I think that from a luxury hotels point of view, there are of course three factors to looking at different asset classes and when they break even. The first is of course the premium rate, which luxury hotels take the benefit of. Again, you've got the ancillary revenues, the conference inn, the variety of the facilities in the hotel that they can also drive a premium in, which again is a positive factor to this analysis. And then you've got the higher cost base, and of course that cost base has been eaten into in a huge way right now. So it's not actually that surprising to me that the luxury hotels are able to break even at around 30% in the current environment. But it's how long that can be sustained for. If it carries on as things are, and if the costs don't creep back into the business in the way we anticipate they will, then as the revenues ramp up, we could be looking at a much more profitable model, and with a lower cost base and the advantage of all areas of the building open, at a lower occupancy, you should be able to break even indeed.
I'd like to add one more thing, which is the quality of the management is hugely important. If you've got a good manager and a good management team, they can achieve a lot more than if you just have a mediocre management team. So the quality of that management is really key to making sure that you can drive as much revenue and profit out of that business.
So this seems like COVID has actually taught us some things that we did not know about the hotel industry before. Perhaps to come to a conclusion, Michael, what was the most surprising analysis or conclusion that you took out of analyzing the numbers that you reviewed since March and that you have received? If you had to wrap it up in one statement, what was the most surprising lesson that you could draw from them?
I think the evolving reality of you can't look at prior events to try and assess how we're going to come out the other side of this. That came quite early in the crisis. I think, measuring the impact of 9/11 and the global financial crisis and trying to compare that to what happened now, I think was something that we did, but basically just to provoke the thought that it's not worth looking at that history now. It's really very much real time. And even up to the current month, I mean, things are evolving so quickly that the current month, we will see things come out of November reporting that will look totally different to October's reporting. So it's the speed in which the cost lines and the demand is changing month on month that has really surprised me. If I can throw another one in there from the luxury hotels, because of course looking at the data in particular for this presentation was the impact of food and beverage, and although you're anticipating some impact of social distancing, actually in some circumstances we are seeing increase in food and beverage revenues because the ability to be able to retain guests in the building where the restaurants and bars outside are either closed or limited, and the fact that we're still at quite low occupancies and therefore not feeling the full impact of social distancing right now in the outlets.
Cool. And Russell, you've just mentioned 45 years of experience in the hotel industry. What have the past 6 months taught you about the hotel industry that you did not know before?
It's that people who operate hotels have the opportunity to get their cost base right. One of the things that used to really aggravate me when I was reviewing a hotel's marketing plan for the coming year is how many of the expenses in the marketing budget were just a repeat of what had gone on before. And they didn't take a critical look at absolutely every penny that they were spending and justify them in the future. Now we're starting with a zero-based budgeting, with a blank sheet of paper, and every single expense that gets added back needs to be justifiable. So at last, I'm hopeful that we are going to see budgets that are based on absolute proven necessity and not just because we've done it before, we're going to do it again. And that doesn't just affect marketing budgets, it affects all sorts of aspects of the budget, whether it's people related, whether it's expense related. And I do look forward, therefore, as Michael has alluded to a much more profitable and meaningful profile of a hotel's P&L into the future. And that will again make this sector even more attractive to the investment community who really do look at the hotel business and think, wow, here's a business I want to invest in. So let's go and do it.
Wow, Russell, this is a fantastic statement that I really like to hear. As I said, we have been scrutinized for investing so much in hotels, and perhaps something that I have learned in the past couple of months, I'd like to add as a final positive thought, is the hotel industry is an industry that is very adaptable. We're talking here about adapting costs, about low break-even occupancies. We are here experts from this industry who has suffered the most through COVID and who is still positive and who is adjusting itself to stay positive in the future and to come out at the other end of this much stronger. And I think this is a nice thought, and I think this is something that we would like to end with today. Thank you, Russell. Thank you, Michael. And perhaps in about 3 months, or I don't know how long, we will talk about this moment and say, remember when we thought that the GOP was only around 40%? Now it is much changed, and that is because of COVID. So that will be hopefully someday in the future.
Excellent. Thank you very much indeed.
Indeed. Thank you.
Bye.